Hey guys, Toby Mathis here. Today we're going to go over 3 rules for setting up a new business. And I'm just going to do like a 10,000-foot view of all the things you should be considering because there's so much bad advice out there. I want to make sure that you know exactly what to focus in on, what's really relevant, and make sure you don't just use a rule of thumb that ends up causing you a bunch of money or causing you pain and heartache in the future. So let's dive right on in. When you are setting up a new business, there are some things that we need to know in order to determine what is the best way to set it up, both from a tax structure, from an entity structure, how to make sure it's compliant, and there are so many different options out there. You've probably heard of a ton of them: limited partnerships, sole proprietorships, partnerships, general partnerships, corporations, S corporations, C corporations, LLCs, limited liability companies, taxed as S corps, LLCs taxed as C corps, LLCs taxed as partnerships, limited partnerships. You have a ton of different state designations. And then you also have tax designations, whether it be sole proprietorship, partnership, S corp, C corp, even 501c3s. What is appropriate under your circumstances? And so we have to narrow down and immediately figure out what category we are in. Are we in a category where it's just you, solo? Are there other owners? Are there investors? We want to know these broad categories so that you can make the best decision and follow these rules. Is it going to be an active or a passive business? In other words, are you buying an apartment building? Are you running an actual business, a brick and mortar business? Is this something that maybe doing software or something that's online? All of these are considerations. Are you doing something that maybe is just investing? And really what you're doing is you're putting a bunch of folks together that are going to go in and buy a bunch of real estate, maybe a passive investment. Are you flipping that real estate, which would make it active, right? All those things. It's just knowing those basics so that we can point you in the right direction. Once you know that, then we can follow these 3 rules. And these 3 rules are extraordinarily simple, and that it comes down to this. Number 1, do not do business in your name. Use an entity, always. And why do I say that? There's such a knee-jerk reaction in so many accountants. They'll be like, just do a sole proprietorship. Okay, that is a tax designation. If you just start doing business in your name, or you make a fake name, a fictitious name, a DBA, and you just start doing business, you are no different than that business. So if that business has a liability, it's your liability. And this can be devastating to you if you make a mistake, if there's something you don't know and you step on a state law, a local ordinance, or you violate somebody, like you have an employee that you thought was an independent contractor and they sue the heck out of you. It's personal responsibility. And so we're always going to say, use an entity to isolate to the extent the state law allows. Use an entity to avoid personal responsibility for business obligations. Separate that business from you. And the example I'll give you is, let's say you decide, I'm going to be a plumber. And you decide, I'm going to go out and start plumbing. I'm going to do, ABC plumbing. And you just do a DBA. Your accountant says, we'll just do it as a sole proprietorship. Don't worry about doing anything with the state. We'll just fix it at the end of the tax year. And you go down and you accidentally, I'll give you a real life situation, somebody did not, their worker did not put the adhesive on a piping process, whatever you call that, where the pipes were connected and it came apart in the wall in a multi-million-dollar house. For 2 days, the water ran inside that house. It caused $1.5 million worth of damage. Person was not in a situation where they could pay for it. The insurance was woefully inadequate under those circumstances because, again, they were just doing it on the cheap, and my accountant said not to worry about it and everything else. Don't listen to your accountant when it comes to legal liability, right? They're really great on tax, but as far as responsibility for those types of obligations, it's going to rest with you personally if you don't set this up appropriately. So that person got wiped out. It literally took everything that they owned. They had a judgment that they got to continue to pay on over many, many years. Not something that you want. It almost put them into bankruptcy. They probably should have gone into bankruptcy, after the pain that they endured. It would have been avoided had they simply used an entity like an LLC, like a corporation with the state. What it does is it isolates the business liabilities and maintains and keeps them inside the business. It's like a box. And just imagine that you put the business in the box. Anything that happens in the business stays in the box. You don't have a box, it's all over you. You may as well be holding that business, and now you're responsible for anything it does. Now, you'll hear us a lot of times, especially on this channel, and my partner Clint Coons has a great channel as well, talking about what about liability that we incur personally coming to get the business. There are protections you can use as well, but you always use an entity. But for our purposes today, we're only talking about inside liability inside that business and making sure that it doesn't come out and get you individually. We do not want a business liability. For example, let's say you're running your business and something like COVID happens, right? And all of a sudden you have obligations, you can't operate, you're having a difficulty, and you run up your credit cards, you have all these personal obligations because of this business. We don't want them to become personal obligations that wipe you out as well. We want to isolate it and keep it just inside that business, which requires that we create a separate person under the law, which is an LLC or a corporation. And so you're looking at it and saying, what type of entity is appropriate? For example, if I'm using real estate and I'm just buying a rental property, I might use an LLC that is disregarded for tax purposes. If I'm setting up a business and I anticipate I'm going to make $100,000 to $200,000 a year, I might set up an LLC and make it an S Corp for tax purposes, or a C Corp for tax purposes, right? But I'm going to pick the entity. If I think I'm going to sell the entity, like a lot of people miss this one, there is a capital gain exclusion if it's a C Corp. I might look at that. Or there might be losses that I could take individually if the business fails and I lose money. Or if I'm going to lose money in the beginning, like, hey, I'm estimating that the first 3 or 4 years may be loss, I may not want to deal with the hobby loss rules. I may choose a specific type of entity that allows me so I don't have to, right? That doesn't have to comply with that rule. Those are all things that are on the table. And by the way, if this starts to confuse you, all you have to do is go down to the comments below and type in consult. And we can have somebody reach out, and we'll send you a link actually, so you can schedule a time, a no obligation free consult with an expert, so you can actually ask questions and say, this is what I'm doing, so they can troubleshoot for you and figure out what issues that would relate to you and what you're doing and what might be the best path forward. So if you get confused during any of this, don't worry, hang on, keep watching, and then start writing down your questions. Even put those in comments and we'll respond to you as well. But you can just put consult if it starts to seem overwhelming. So number one is, what type of entity and where should I set it up? If I am doing real estate, I'm probably going to have an entity in that state where that real estate is held. I'm probably not going to go outside the state, set something up, and then I'll have to register it as a foreign business doing that. Or if I'm an active business, it really depends on the type of business. If I'm running a mini mart, I'm brick and mortar in the state, I'm going to have to be in that state. But if I am doing something that is not brick and mortar, maybe I'm going all 50 states and I have an internet business, I may headquarter it someplace else. You always hear about Delaware, Wyoming, and Nevada. There's a reason for that, depending on what you're trying to accomplish and whether you have investors or not, what rules you want to fall under, you get to choose. And so you get to pick what type of entity and where. That's number one, is always use an entity and make sure that you're using the appropriate entity. Talk to an expert if you don't know. Real simple. Number two, choose your tax treatment. And I'll say choose your tax treatment carefully. And let me give you a reason why. If I set up, and I go to my accountant, set up a business, and maybe it's a plumbing business, and I anticipate I'm going to make $100,000 a year. If I set that up as a sole proprietorship, I'm going to pay something called employment taxes, old age, disability, and survivors, and Medicare. I'm going to be paying 15.3% on the entire $100,000 of profit. Whereas if I set up as an S corporation for tax purposes, I would not have, I'd probably be paying about $8,000 or $9,000 less in tax, simply because of the tax designation. Because one pays employment taxes on 100% of its profits, the other one pays no employment taxes on profit. You just have to take a small salary and you pay employment taxes on the salary. The reason that is so critical is because even on like a simple business that's making $100,000 a year, it can make a that's almost a 10%, sometimes it's more, difference just from the tax treatment. There are tax differences on these entities. I'm just saying sole proprietorships, general partnerships, limited partnerships, S corporations, C corporations, even 501c3s. All of these are taxed differently. They have different benefits. For example, I can reimburse 100% of your medical, dental, and vision expenses in a C corp. I can't do that tax-free out of an S corp or a sole proprietorship. There's a huge difference on little nuances. One, I might have a C corp that has a separate tax return. It might be a better tax bracket than if it had been me personally, if it flows onto my return. All of those things you're going to want to consider. You're going to want to talk to somebody. Again, you can just type in consult if you want to talk to an expert, and they can give you your options and say, here's a way to save some money. But what you don't want to do is just go and say, hey, the easiest thing is for me to operate in my name and use a sole proprietorship, because chances are you're exposing yourself to unlimited liability and the highest tax brackets and the worst tax treatment under the law. Now, that doesn't mean that you just never set up a sole proprietorship. If it's a small business, if it's making $10,000, $15,000, $20,000 a year, probably just going to leave it as a sole proprietor. From a tax standpoint, we're still going to use an entity so that you're not liable for anything that happens or anything the employees do or any of your contractors or any of those. You may step on a liability without even realizing it. We just want to make sure it doesn't come in and get you, and then we want to make sure it's treated appropriately from a tax standpoint. And the big ones are sole proprietorships, S corporations, and C corporations when it comes to active businesses. When it's a passive business, like real estate, chances are you're going to either have disregarded or partnerships. It depends on what you are engaged in. And there's a very real reason why we do that, because there's a huge tax negative if I own things like real estate inside of an S corp or a C corp. I do not want to cause taxable events where I don't even sell the property. I could cause a taxable event just by moving the property, to refi it into my name, to refi it and put it back in. That could be a huge taxable event for you if you're using an S corp or a C corp in a passive enterprise. So you got to make sure that you have somebody that you're talking to so you don't step on any of those landmines. And number 3, you want to make sure that that business is compliant. And so I'm just going to call it compliant. You want to be compliant. Keep compliant. And what do I mean by compliant? You set up a business, there's an obligation underneath the IRS, Internal Revenue Code, that you have to keep separate books and records and maintain its expenses and its income separately from your other businesses and your personal. If you mix those things up, you're going to cause yourself problems. Same thing is if I want to have the benefit of an entity, there are things I have to do on an annual basis to keep compliant. Sometimes it's just paying an annual fee. Sometimes it's having a certain number of meetings, filing it with the state, paying a fee, maintaining separate P&L, separate balance sheet, separate books is all that is. And whether you're a sole proprietorship, partnership, S corp, C corp, it does not matter. You have to keep separate books and records underneath the tax laws. You have to do it. So if you are going to go into business, just know going in, I need to make sure that I'm separating out those books. I want to keep a separate bank account 99% of the time, and I want to have my P&L and my balance sheet for that business separate from my personal assets. Again, you go into the accountant, they may just say, set up a sole proprietorship, you're good, and don't worry, we'll do your books at the end of the year. Don't do that. Have your books set up proactively. Make sure that you're maintaining them. Even if it's a small activity, low activity, do it on an Excel spreadsheet. It's not hard to do, but you want to keep those books and records separate so that you get treated separately. You intermingle this stuff, you don't show enough respect to your business, the courts won't show respect to your business. The banks won't show respect to your business. Nobody will show respect to your business. So you want to make sure that you are keeping separate, that you are maintaining compliance with the state. And then little things like if I use an LLC or I use a corporation, there's things called bylaws and operating agreements, partnership agreements if you're using a partnership, limited partnership agreement if you're using a limited partnership. These are the rule books under which it's operating, and not all created equal. You want to make sure you're talking to somebody who does this day in and day out. Don't use some boilerplate thing that you get off the internet or that you use Legal Doom or one of these online things where they're just going to give you a boilerplate document, because chances are it's going to hurt you. Use somebody who does this day in and day out. It'll save you so much pain and suffering in the future, especially as you grow. You're not going to know when you're going to step on that landmine and cause yourself pain. You want to make sure that it's already been addressed proactively from somebody who knows what they're doing with those types of businesses. Again, if you want to talk to somebody in our offices, just type in down in the comments below, consult, and we'll send you a link so that you can set up a free consult and talk to somebody who's an expert. All right, guys, that is it. If you like this type of information, like and subscribe. If you know anybody who's setting up a new business, forward this to them and make sure that they are looking at the 3 rules to setting up a new business.